If you purchase your health insurance through the insurance marketplace, also called the exchanges, the events I've mentioned here could also affect your taxes in a second, indirect way. Changes in your income, employment status, or family size may affect your eligibility for the Affordable Care Act premium tax credit or change the amount of your credit. Such a change could impact both your tax bill and your monthly insurance premiums. Therefore, one key component of annual tax planning is keeping the exchange where you purchased your health insurance informed about any changes in your circumstances. Another major tax planning consideration each year is finding the best strategy to contribute to any tax-advantaged accounts you may have. Examples of these accounts include IRAs, workplace retirement programs, health savings accounts or HSAs, and health flexible spending arrangements or FSAs. For some of these plans, the difference between a well-thought-out contribution strategy and a haphazard one could be thousands of dollars each year. The bottom line here is that getting your largest possible refund in the spring does not necessarily mean that you got your best possible tax deal. Responding to significant life changes when they occurred might have made far greater tax savings possible. Of course, it's hard to keep track of every factor that could influence your tax bill while living a busy life. One way to ease that mental burden is to schedule a tax planning checkup or two each year. These meetings can help ensure that you do not miss out on any tax benefits and do make needed adjustments to your withholding or tax payments all before the coin gets flipped. We often recommend a meeting in late spring or early summer when the stress of filing season has passed, but the outcome of your last tax return is still fresh in your mind. It can also be helpful to meet in the early fall, before the deadline to make changes to your health insurance or to your contribution strategy for an FSA or HSA for the coming year. We would be happy to talk with you about the best checkup schedule for your circumstances. Once you have settled on your best tax strategies for the current year, it is time to widen your view. The most effective tax planning looks years into the future. Let's look at 2 examples to see why. Suppose that during a certain year, Karina takes several classes to improve her job skills, which qualifies her to claim a lifetime learning credit of $2,000 that year. That same year, she installs solar panels on her home, which could qualify her for a clean energy tax credit of $3,800. She also makes several energy efficiency improvements, making her eligible for an additional energy credit of $1,400. For that year, Karina owes $4,200 in federal income tax. The problem here is that the tax credits Karina could claim are non-refundable, which means that she cannot receive any portion of the credits as a tax refund. Once your non-refundable credits reduce your tax to zero, you simply forfeit any remaining credit amount. So in this scenario, the fact that Karina's credits add up to far more than her tax bill means that a significant portion of those credits goes to waste. This table shows how the credits actually work out on Karina's tax return for the year. Feel free to pause the video to review the table in detail. The end result is that while the credits reduce Karina's tax to zero, saving her $4,200, she also left $3,000 worth of tax credits on the table. In effect, she gave away $3,000, and that's money she can never get back. With advanced tax planning, Karina could have identified the risk of wasting tax credits before investing in her home energy improvements. She could have then staggered her investments in education, clean energy, and home efficiency over multiple years, potentially enabling her to claim every dollar of each tax credit. In other words, by strategically timing when she qualified for each credit, she could have gotten up to an additional $3,000 in tax savings over the years.